All right. Well, I'm Spencer.Leamer with Realogic Sotheby's International Realty in Bellevue, Washington. And I wanted to put this video together for consumers in the area and just get together with my buddy Tom here, who works for Guild Mortgage, and just kind of do a recap on the week, kind of get some thoughts about the market and where things are headed and what to expect. So I've not been a realtor that long, if we're being honest. January of 21 is when I got my license and started with a different brokerage here in Seattle. And before that, I was in construction. I worked for a big civil contractor here in Seattle and worked on contracts and project management. So decided, hey, why not add a little bit more stress and sleepless nights to my life and get into real estate. So Tom, tell us about you. What's your story?
Yeah, so again, my name is Tom Goldsmith. I'm a mortgage banker for Guild Mortgage in Bellevue. I've been in the mortgage business for over 20 years. I've been with Guild now for almost 4. It'll be July 1st. It'll be 4 years. Before that, I was with a couple other firms. One in particular, I actually had a minority ownership in. Prior to that, 20 years ago, I had, worked for a family company, a couple sales jobs, but got into the mortgage industry in 2001 and never looked back. I'm a graduate of Gonzaga University in Spokane, O'Day High School in Seattle, Washington. My family, I have 8 brothers and sisters, and we all grew up in Kirkland, Washington. That's about it. Other than 4 years of college, I've lived my whole life in the Seattle area. So yeah, that's about it for me. I'm but proud to still be in the mortgage business and helping people like Spencer's clients get the best mortgage products they can get.
Love it. So I think we need to talk about the elephant in the room, Tom. The Fed just raised the fund rate 0.75 points, and inflation is going through the roof. Gas prices are $6.50 a gallon here in Seattle, and food prices, and so on and so forth. What are you telling your clients right now? How are you advising them in this crazy market that we're in?
Well, as you pointed out off air, the market right now is really terrific for buyers. And so even though people in their minds, they're used to these, 3.5% interest rates, now we're up above 6. It's putting some people off purchasing, basically because their monthly payment would be higher. But really what's happened is by the rates popping up like that, that has opened the door for a lot of people who come to me, get pre-approved, and I'm pre-approving them, at that 6% level, so then if they come back, everything's fine. But I'm advising them to, even if you have to augment your purchase price by just a little bit, still a great time to get out and purchase. And, quite frankly, we've been spoiled for 20 years on this mortgage rate thing. When I got into the business, the mortgage rates were, upwards of 8 to 9%. And people were refinancing with me to get down to 6%.
Yes.
And so we've had a 20-year run that's just been unprecedented, because prior to that, you never saw rates below 6%. And so it's really been quite a run. So really, we're almost back to normal. And so I try to advise my clients, you got to look at it that way. and don't stress about the past and what's behind and, oh, should have pulled the trigger back, last year sometime. You can't think that way, because going forward, this is reality. This is what we have. So if you really want to buy a house, let's work the numbers and make sure that it's something you feel comfortable with, and move forward.
I remember talking to so many people last year, and they're like, no, this is crazy. Prices are crazy. This is a year ago.
Mm-hmm.
And prices are crazy. I'm going to wait for the market to come down. I think it's going to drop, 20, 30%. This looks like 2008 all over again. Yada, yada, yada. I'm sure you hear the same thing from consumers.
Sure.
And all I'm saying is, how did that work out for you?
Yeah, no, it's tough. Interesting. Speaking with, there's a gentleman who's an instructor for, he's got a company where he trains mortgage professionals, and we have to take continuing education every year, just like you do, to keep our licenses up. And so I've been going to this guy's classes every year for 12 years, something like that. And he's terrific. And he was telling a story about how he was riding in a cab last year in Portland, and they were talking, and the guy in the cab was sitting there saying, yeah, I'd like to buy a house, but I'm waiting. I'm going to wait till those prices come down. We're going to hit this bubble. It's going to burst just like 2008, 2009. And then he basically, he didn't say anything to the guy, but what he said to us was, that's not going to happen. The reason being is, in 2008, 2009, there were so many bad mortgages out there. I mean, just a ton of bad mortgages. And this is what really caused the bubble to burst back then. Mm-hmm. Here we are now, and the mortgage market, there's no bad mortgages out there. Because of the heavy restrictions they put on lending back in the 2010, 2011, we can't. There's no bad mortgages out there. So literally, it's if you're thinking that there's going to be a bubble that's going to burst and the prices will come down, you're wasting your time. The prices will probably level off. We're not going to see, because as you pointed out earlier, really we're seeing a softening of some of the bidding wars and that sort of thing. So because of that, we'll see things level off a little bit. But are we going to see this 10, 20, 30%
crash?
No, I don't see that happening at all.
Yeah, you said something that piqued my interest, and it flew away like a fart in the wind. So okay. I'll come back to it. But that brings me to a point. I love data. Tom, I'm sure you love data, because we could sit here and talk anecdotally all day long about how we feel. But what do the numbers say right now? And I want to show my screen here. There we go. So we're looking at, and these are just some, this is from Everett to Federal Way, basically in Western Washington. So that's going to cover, Snohomish, King, Pierce counties, for the most part, basically the busiest areas. And we've got new listings. I mean, even going back to August, been over 800 for the most part. Uh-huh. And we're seeing now, they're exceeding about 900. They're touching 1,000 in some cases. But the interesting part is actually this pending and sold category over here. We've just kind of seen it drop almost off a cliff. Mm-hmm. As far as activity on the week goes. Mm-hmm. And as I'll show you in a second, we've got days on market, again, like up towards 2 weeks, which even 3 months ago was like an average of 4 or 5 days. Right. Which is insane. Right. the other point that I wanted to make with this is the price reductions that we're seeing.
Mm-hmm.
I'm almost seeing a 40 to 50% of the new listings that hit the market see a price reduction.
How much is that? How much of that do you think is people trying to put their house on the market for a really high price that's not comparable to other sales, because they're just trying to take advantage of the seller's market?
Yeah. I think there's a lot of people out there, a lot of sellers out there who we hit this wall, right? And the sellers were still incredibly aspirational. They were heading up on this trend line going this way. And all of a sudden buyers lift off the gas pedal completely and are going back down this way as far as activity goes. And sellers a lot of sellers just kind of got caught with their pants down, if we're being honest. And I think now the pricing strategy for sellers has completely changed. We're not hardly seeing any review dates anymore on the week. And we're seeing maybe 1, 2, 3 offers come in on houses that just 2 months ago would have gotten 15.
Right.
In fact, we put a listing on Finn Hill in Kirkland, which is a super hot area, great schools, good residential neighborhood. And it was that week where everything just kind of dropped off a cliff. And the activity, which was just, it was dismal. Unfortunately.
You mean activity is like open house?
Yeah, open house activity, private tour activity. The neighbor next door, like a couple of months ago, had people lined out the door down the street for their open houses. And we're seeing this across the board, really, especially in that like sub 3 million price point, maybe like 1.3 to 3 million. And yeah, it's just been a roller coaster, but yeah.
But we are seeing, at the same time, we're seeing buyers sort of taper or start waiting. We're seeing more listings come on the market. Is that correct?
That's true. Yeah. So yeah,
so then buyers can be a little more picky.
Absolutely. So it's great. Like, this is almost Nikki and I bought a house or a condo in 2018, and we had zero competition. And then all of a sudden it picked right back up in 2019. So that it kind of reminds me of that. But when you start, this graph here is just showing the new listings versus sold versus pending. And when we start seeing the new listings shift and start to exceed sold listings, that's usually an indicator that the pendulum's kind of swinging back in the other direction. Pendings are down, sales overall are down across pretty much all price points. I will say the like sub $750,000 price point here in King County still fairly hot. So like 2-bedroom condos or 2- and 3-bedroom townhomes.
Is that just the affordability factor, you think?
I think so. You got Bobby and Susie, they were shopping at $1 million 2-3 months ago. Now they're shopping at what, $850,000?
Yeah, because of mortgage rates going up.
Because of mortgage rates going up, and they're still, in that same payment range. Yeah, so that's, that's kind of what we're seeing. Activity's low, competition's low. I would still, though, if I was a buyer, still expect there to be competition on these
Yeah,
homes that are, renovated in good neighborhoods with good schools.
right.
Like, still expect that if it's
And
been
that
on for 2 weeks or less.
and that's why when we get clients in here to get pre-approved for a mortgage, we do the pre-approval, but then we take it a step further. We make sure that the client's file goes to underwriting, goes to the people who approve the loans, and get that done prior to purchasing something, because then they become a stronger buyer than the competition.
Mm-hmm. We're always, I think Seattle's always going to be an inventory starved market for the foreseeable future, unless they can figure this regulation piece out and ease that part up on builders. Because I've been talking to some of my builder friends, and it's insane the amount of regulation that's involved in building a house out here.
Oh yeah.
And so, here's another chart. This is days on market going all the way back to 2006. We saw the market crash in 2008, and you obviously got huge days on market. And, now we're down to an average of about 2 weeks for all 4 of these counties in the central Puget Sound region. So
that's good data. Yeah, I like that data. That's cool.
Yeah, thanks, NWMLS.
Love those guys.
Yes. So go. Yeah. I mean,
let me just kind of clear up really quick. If you don't mind, I'll shift gears just really quickly.
Yeah, shift it.
I just want to clear up some issues people have as far as, they automatically hear, like, the Fed is going to raise interest rates. Automatically, I get phone calls.
Busting.
What's that?
Let's do some myth busting.
Yeah. So people, are freaking out, and they give me a call and say, what's the deal? Our rates now way up. And I'm like, okay, when the Fed says they're going to raise interest rates, that is short-term interest rates. Okay. That's having to do with things like your credit card or an equity line of credit or any short-term financing you do. It's going to affect that. Okay. How it affects mortgage rates is it's more of an emotional reaction. So basically, I'll read for you really quick what one of our economists here at Guild wrote. He said, the most important part of today's announcement with respect to mortgage industry is any update from the Fed about how much they are reducing their monthly purchase of mortgage-backed securities to their portfolio. And in the worst case scenario, if they make any hint of selling mortgage-backed securities currently held in their portfolio. Okay, what he's talking about is the reason we had mortgage rates down so low to record lows is mostly because of the federal government stepped in and was purchasing bonds and mortgage-backed securities. Billions of dollars worth, and that was actually pushing mortgage rates down artificially. And they wanted to do that because during COVID, they're looking for stimulus, right? And so they kept buying billions of dollars worth of these things. Well, now they announced, this winter, they were going to start tapering that bond buying program. So they have been buying less and less and less. And what that has done has caused mortgage rates to go up. You can always, it's hard to find numbers on mortgage-backed securities, but if you look at the 10-year note, the 10-year bond, that usually mirrors it. So you could look at that and get a good sense. So the yield, and it's really tough to explain all this, but just take it as raw numbers. The yield on the 10-year note 6 months ago was like 0.79. Okay. Now the yield is 3.5 or 3.319. You got it right there.
There we go.
And yeah, so think of that jump between 0.75 or 0.8 all the way to 3.319. That's unprecedented, especially in the short time that we're talking about.
Yeah.
So that's one reason mortgage rates have gone up, is because the Fed has tapered their bond buying program. The other part of it is, of course, inflation. And inflation, what happens is if the mortgage rates don't match or exceed inflation numbers, then the lender who owns that mortgage is losing money. End of story. So if we've got inflation at 7% and we've got rates at 5.5%, that's a losing deal. So that's the other thing that's pushing mortgage rates up, is the inflation piece. And those of you who are watching who were around in the late 70s and early 80s will remember inflation was off the charts. And because of that, so were the mortgage rates. They went up to 14, 15, 16%. And not saying that's where we're going, but so inflation is a big part of the mortgage rates taking the leap like this.
Mm-hmm. What would you say the differences are? Because I hear this all the time. It's like, hey, real estate agents use this all the time, right? It's like, hey, rates, remember rates back in the 70s, they were up in the teens.
Mm-hmm.
Like, it was crazy. Like, have some perspective here. But
Right.
at the same time, like, what was the dollar went, your dollar went further back then. Are we right?
Yeah. I mean, but in the early 80s, inflation was double digits. So people were hurting all over the place. I sort of remember it. I was like 13, 14 at the time. I'm aging myself, but that's all right. I was 13 and 14. So I remember watching my father and my mother, struggle with things and really pull back. They were in kind of the housing development business, civil engineering to be specific. So they worked for builders. So when things were like that and they weren't building homes and nobody was buying homes, it really made an impact. So, but like you were saying, trying to keep that in perspective, it's still difficult for the young people of today, to look at that and so what? This is what's happening to me today. But I'm just trying to let them know, 6% is still a really good number.
And hey, why not refinance when they drop again, right?
Yep. You can always do that. Like I said, when I got in the business, I had people at 8, 9, 10% refinancing to 6%. A year later, they were refinancing to 5%, and so on and so on. Yeah. So you can always refinance, but what's important is getting the house, getting in there and start building your equity instead of throwing away money to rent.
I always tell people time in the market, not timing the market.
Right. Yeah. Oh, it's, Spencer, if you don't mind me throwing something else in.
Yeah.
I was watching CNBC this morning, and one of the things they were pointing out was, how is it that this market works where, people, sure, they can sell their house for a premium.
Yeah.
Okay. But let's say that their mortgage rate is 3% on that house. Then they sell it, but then they got to turn around and buy something at 6%.
Yeah.
Why would they do that?
Yeah.
Well, and that's a very excellent question, and probably one reason why, another reason why some of the buyers have fallen off. But one of the things to keep in mind, and why we think that housing will pick up in the fall, is because of COVID. There are a ton of people who can work remotely now.
Oh yeah.
So what we're finding is people are selling their home for top dollar in wherever market they are, and then moving to a market that is less dense, less populated, and the price point of homes is lower. And really, this remote working thing has worked in favor of a lot of sellers, that they're able to make that jump. And even though the mortgage rate on their new mortgage would be 6.5%, they're still probably paying less than they would have on their old house at 3%.
Mhm. Yeah, it's definitely changed the game. And I, talk to senior brokers that have been doing this for 30 years at the office. They've never seen a market like this.
Yeah.
And the whole work from home thing has totally changed everything. But now you've got, maybe people are going back to the office like 2 days a week. I've got a buddy
Yeah.
who works for Uber, and they're like, yeah, well, we're gonna do 2 days, and maybe do one day, and nobody's really sure how this thing's gonna work out.
Right. Right. I think some of the bigger tech companies, they're going to probably have their people come back for the most part, or they may just have them, work a few days a week. We'll see what happens. But I would say overall, there's just a lot of people with decent paying jobs now who can work remotely, and it's giving them the opportunity to relocate and find something. So, it's like, why sell a house at 3% when you're going to have to buy a house at 6%?
Yeah.
Well, if you're selling a house in a high market and going to a lower market, it definitely makes sense.
Yeah. That's how you play the game.
Yeah. Not that it doesn't make sense for them to purchase a house in the high market as well. If they find what they want, man, go for it.
Yeah, I'm sure there's a lot of people out there, right, who couldn't buy their home that they currently live in today.
Right.
I mean, you got all these people that have been in their houses for 30 years over in Kirkland, and there's no way they could buy that same house today.
The beauty of homeownership.
Yeah. And that, that's important. I think good segue into, look at our median sales price here in the Central Puget Sound region since 2006. So market crash, subprime mortgage crash.
Mm-hmm.
So, we really started a rebound in about, 2011, 2012.
Right.
And it took about 5 years to double the price of the houses. And then it took another 5 years to almost do the same thing.
Mm-hmm.
And this could be different for other markets around the United States, but at least here in the Seattle market, we have such a diverse job market. We've got biotech, regular tech, manufacturing, healthcare. You got all these different industries here. And on top of that, the air's clean. There's green everywhere. Yeah,
Mm-hmm.
It rains a little bit, but if you can get past, not getting a tan every day when you walk outside, it's not a bad place to live. So, I think that's why you're seeing a lot of people move here, and home prices just naturally increase. We just don't have enough homes for people.
Yeah. Yeah. I think we'll see those prices start to level off though. So
yeah, totally.
Another good piece of news for buyers.
Totally. They need to correct. They're just, the price of home, the rate of change on the homes versus the people's wages is just getting out of control.
Yeah, it'll catch you. I mean, I remember this happened in San Francisco about 15 years ago.
Yeah.
Where the prices just went through the roof, and it was just insane. You couldn't find anything less than $1 million in the city, and then it's stabilized, and there's still high prices down there, but it's like kind of used to it now.
Yeah, we're in Seattle. I think their median price point hit 900 last month.
Did it?
For a single family home.
Mm-hmm.
And you got to have at least $1.5 million to buy here on the east side. It's
right.
It's nuts. 1.8 million median price point.
Bellevue, Kirkland, Bothell,
Bellevue,
Sammamish.
Kirkland, Sammamish, Redmond, Issaquah, all those areas east of Lake Washington.
Yeah. But the best way to find out if you can afford to do anything with that is
talk to a lender.
Yeah, talk to me, and I'll make sure that we get the numbers right, and then but then you at least know, right? That's what I tell people. It's like, well, we're just not sure we want to buy yet, no, and we don't know what to. It's like, you know what? Get me a loan application and some paperwork, and we'll take a look, and then you know.
It's free.
Yeah.
Yeah.
Doesn't cost anything.
It doesn't cost you anything other than a couple of points on your credit score.
Right. But even that's just minimal. It's like 3 points.
Yeah.
So.
And then because I talked to, there's so many people, like when I first started in real estate, I was eager, right? Is to go like, yeah, go.
Right.
And you run into a situation as a buyer where you fall in love with this townhome or whatever. And then you find out, oh, my credit score is 550, or
Right.
I can't afford an $800,000 townhome. I can only afford a $600,000 2-bedroom condo. So talk to a mortgage professional today.
Yeah. Then at least you have a direction. You know where you stand.
You know where to shop.
Yeah, you just don't know. You don't know what you don't know, and that's my job, is to help your clients figure out what they can do and what they feel comfortable. My niece, I pre-approved her. I don't know, this was a long time ago.
Yeah.
And they were in my office, and I said, "Okay, would you like to see what you're pre-approved to buy?" And sure. And I said, "You're pre-approved to buy a home for $800,000." And they're like, "Wow, that's fantastic." I go, "Now, would you like to see what the payment is on that $800,000? And they're like, "Yeah." And I go, "Here's the payment." And they were like, "Oh, we don't want to pay that every month." And I said, "Right. So here's what we're going to do. Yes, you're pre-approved to buy at this level, but you need to be comfortable with your monthly payment."
Yeah.
So then we augmented the numbers, brought it down. I think it was around 700,000 or 650 or something, where they felt comfortable at that payment level. Yeah. And then they were able to go out and shop for a house for that, which they found.
Are there mortgage products out there hitting 50% DTI?
Oh yeah.
Yeah.
Well, any Fannie Mae loan, or Freddie Mac for that matter, and the max loan amount for that is $891,250.
Yeah.
Okay, that's the max. Anything above that's a jumbo loan.
They just raised those, yeah.
But below that number, if your loan is below 891, then the debt to income ratio can go up to 50. Or just under 50. Unless it's an FHA, then it can go over 50. But so jumbo loans, if your loan is going to be more than 891,000, that's not purchase price, that's the loan amount. It's going to be more than that, then the high-end DTI, and for those who don't know what that means, is debt to income ratio. Mm-hmm. So that's your income thrown against the wall with whatever debt you have, and what's the percentage of your debt to income. But the debt to income ratio for jumbos is 43%.
Yeah.
So
crazy.
Mm-hmm.
Well, you want to wrap this thing up? And
yeah, we'll wrap it up for today. We'll pick it up again next week. I'm sure there'll be a lot more news in the next week we can cover, and go from there. But yeah, big day. The Feds, I think, honestly, in the long term, this is going to be a good thing. Short term probably won't make people too happy, but we are seeing, because of the Fed's aggressive move today, we are seeing rates tick down just a smidge.
Yeah.
So which is good. That's good news. Maybe we're heading in the right direction. I don't know, but they have improved a little today.
Yeah. And on the sales side, obviously, get out there and start shopping for a house if you can afford one, because you ain't have no competition right now.
That's right.
Well, cool. Thanks for jumping on here, Tom.
Yeah, no problem. And if anybody wants to get a pre-approval, just give me a shout. My number's 206.
Oh yeah. How do they connect with you, Tom?
Call me 206-948-9071. My email address is very simple. It's tom@thomasgoldsmith.com. Yeah. And just reach out to Spencer. As far as Spencer and I work really close together, so if you're talking to me, you're talking to him too, basically, or vice versa. So
Totally. Yeah. Well, thanks for watching, and we'll talk to you next week.
yeah. Thanks, Spencer. Thanks for having me.
Thanks, Tom.
Take care.